Here is a number that should grab every investor's attention. Gold has spent much of 2026 trading near record territory, repeatedly testing levels above $3,000 an ounce, a price that would have seemed unthinkable just a few years ago. So what exactly is driving the metal market on Monday the 15th of June, 2026, and where do prices go from here? In the next few minutes we will unpack the latest moves across both precious and industrial metals, explain the forces pushing them, and give you a clear, evidence-based prediction. Whether you trade gold, hold silver, or watch copper as a barometer for the global economy, this analysis is built to help you make sharper decisions. Let's get straight into it. To understand any single day in the metal market, you first have to understand the backdrop. Three forces dominate metal pricing in 2026. First, central bank policy, above all the US Federal Reserve. When interest rates stay high, non-yielding assets like gold face a headwind because investors can earn returns elsewhere. When markets expect cuts, gold tends to rally. Second, the US dollar. Metals are priced in dollars globally, so a weaker dollar makes them cheaper for foreign buyers and typically lifts prices. Third, real-world supply and demand, especially from China, which consumes roughly half of the world's industrial metals. On the 15th of June, all three of these levers are in play at once, and that combination is exactly why the market feels so finely balanced right now. Gold remains the headline act. Its strength through 2026 has been powered by two engines. The first is relentless central bank buying. Institutions including the People's Bank of China and other emerging market banks have been accumulating gold for years to diversify away from the dollar, and that structural demand provides a powerful floor under the price. The second engine is uncertainty. Persistent geopolitical tension, sticky inflation worries, and equity market volatility all push investors toward gold as a store of value. The key thing to watch is the relationship with US interest rate expectations. If incoming inflation data softens and markets grow more confident that rate cuts are coming, expect gold to push higher. If inflation surprises to the upside, gold could see sharp pullbacks as rate cut hopes are pushed back. Silver is the metal that rewards conviction and punishes complacency because it wears two hats at once. Like gold, it is a precious metal and a hedge, but unlike gold, around half of silver demand is industrial. It is essential to solar panels, electronics, and electric vehicle components, which ties it directly to the green energy transition. That dual role makes silver far more volatile than gold. It tends to fall harder in sell-offs but rally faster in upswings. Analysts often watch the gold-to-silver ratio, the number of silver ounces needed to buy 1 ounce of gold. When that ratio sits historically high, many traders view silver as undervalued relative to gold, and a narrowing ratio can signal silver outperformance ahead. For the 15th of June, silver's direction is closely linked to both bullion sentiment and the strength of manufacturing data. If you want one metal that tells you how the global economy is really doing, watch copper, so reliable a signal that traders nickname it Dr. Copper. Copper is everywhere modern growth happens: construction, power grids, electric vehicles, and data centers. Demand is being structurally lifted by electrification and the artificial intelligence boom because data centers and renewable infrastructure are enormously copper-intensive. On the supply side, the world faces a genuine squeeze. Major mines in Chile and Peru have faced disruptions, ore grades are declining, and bringing new mines online can take a decade. That tight supply against rising structural demand is why many forecasters remain bullish on copper over the medium term, even when short-term Chinese property weakness drags on sentiment. Watch Chinese stimulus headlines closely, they move copper fast. Beyond the headliners, aluminium and steel deserve attention because they reveal where industrial activity is heading. Aluminium is energy-intensive to produce. Smelting it consumes huge amounts of electricity, so its price is highly sensitive to energy costs and to power policy in major producers like China. Lightweighting in cars and aircraft, plus packaging and construction demand, keeps a steady bid under the metal. Steel, meanwhile, is the truest mirror of construction and infrastructure spending. Chinese steel demand has softened with its property slowdown, but government infrastructure programs and the global push to rebuild aging grids and railways are providing support elsewhere. Together these base metals confirm a market that is being pulled in two directions, weak traditional construction on one side, and powerful energy transition and infrastructure demand on the other. So what is the outlook from here? Based on the prevailing drivers, the most likely scenario for the weeks ahead is continued strength in precious metals, with gold supported by ongoing central bank buying and any softening in the dollar, while remaining vulnerable to sharp dips if inflation data runs hot. Silver looks set to keep amplifying gold's moves in both directions, so position sizing matters. For industrial metals, copper carries the strongest medium-term case thanks to its structural supply deficit, though it will swing on Chinese data. Treat this as a probability-weighted view, not a guarantee. The single biggest risk to all these forecasts is an unexpected shift in central bank policy or a fresh geopolitical shock. Always confirm with live prices before acting, because markets can reprice within hours. Let's pull it all together. First, the metal market in mid-June 2026 is being steered above all by central bank policy, the dollar, and Chinese demand. Keep those three on your dashboard at all times. Second, separate your thinking. Gold is a defensive store of value, silver is a leverage play on both fear and industry, and copper is your purest read on global growth. Third, the long-term structural story for metals tied to the energy transition and electrification remains genuinely powerful, even when short-term headlines turn negative. The smartest approach is to focus on the underlying drivers rather than chasing daily price noise. If you found this analysis useful, keep following the channel for regular metal market updates, and let us know in the comments which metal you want covered next.